The recent budget bill championed by President Donald Trump has raised concerns about potential complications in the 2026 tax filing season due to significant staffing cuts at the Internal Revenue Service, IRS. According to a report from the National Taxpayer Advocate, the IRS workforce has decreased by approximately 26%, dropping from over 102,000 employees to around 75,700. This reduction stems from a combination of resignations and layoffs encouraged by the Department of Government Efficiency, DOGE. Led by Elon Musk, the cuts have predominantly affected taxpayer services, the Small Business Self-Employed Office, and the IT department. The report highlights that these staffing reductions, coupled with a proposed 20% reduction in IRS funding, could significantly impact the agency's ability to manage the upcoming tax season effectively. The report emphasizes the challenges the IRS faces in preparing for the 2026 filing season, especially with potential tax law changes on the horizon. The House bill includes provisions that could retroactively affect the 2025 tax year, requiring the IRS to swiftly update tax forms and programming. Additionally, the IRS is already experiencing delays in resolving identity theft cases, with cycle times extending up to 20 months. The report warns that without adequate preparation and staffing, taxpayers could face increased difficulties, and the IRS might struggle to maintain its service levels. Aaron M. Collins, the National Taxpayer Advocate, has urged the IRS to take immediate steps to address these issues to mitigate potential disruptions in the upcoming tax season.
Senegal's public debt has reached a critical threshold, with the Ministry of Finance reporting unsustainable levels by March 2025. Debt servicing costs increased by 24% in Q1 2025, following a 44.5% rise in Q4 2024, bringing repayments to approximately $1.4 billion last quarter. The debt, primarily held by commercial banks, is compounded by reduced revenue collection and decreased donor assistance, with external grants plunging by 71%. The IMF has suspended its financing program due to underreported debt and fiscal deficits, revealing a debt-to-GDP ratio of around 100%, significantly higher than the previously stated 74%. Market confidence in Senegal has deteriorated, as evidenced by its dollar-denominated bonds being the poorest performers in Africa. The IMF, while acknowledging potential gains from oil and gas revenues, has stalled discussions on new financing until the misreporting issues are resolved. Credit agencies have downgraded Senegal's outlook to B, and sovereign spreads remain high. The government aims to implement subsidy reforms and improve tax compliance to regain fiscal stability. However, reliance on short-term borrowing and volatile oil markets poses risks to fiscal recovery, necessitating structural reforms in tax policy, public spending, and debt management to avoid a deeper liquidity crisis.
Major U.S. stock indices displayed mixed performance on Wednesday, as market participants closely monitored Federal Reserve Chair Jerome Powell's comments and geopolitical developments. The Dow Jones Industrial Average saw a slight decline of 0.11%, while the S&P 500 and Nasdaq Composite experienced gains of 0.11% and 0.36% respectively. Powell reiterated the Federal Reserve's cautious stance on interest rates, highlighting that any signs of lower-than-expected inflation or labor market weakness could prompt a rate cut. This cautious approach comes amid ongoing tariff-induced price pressures, adding layers of complexity to the Fed's decision-making process. Geopolitical factors also played a role in market dynamics, with a fragile ceasefire between Israel and Iran influencing investor sentiment. In related markets, the yield on the 10-year Treasury note rose slightly to 4.32%, reflecting shifting expectations around interest rates and economic stability. Meanwhile, cryptocurrency stocks surged in tandem with rising Bitcoin prices, with Coinbase Global and Robinhood markets seeing notable gains. Conversely, FedEx and General Mills faced declines due to underwhelming profit forecasts, while Tesla's European sales slump contributed to a 4.3% drop in its stock. Commodities also reacted to geopolitical developments, with gold prices easing as the ceasefire reduced safe haven demand, and oil prices rebounding on renewed assessments of the truce's longevity.
Barclays has announced a significant policy change by prohibiting the use of personal credit and debit cards for cryptocurrency transactions starting June 27, 2025. This move is driven by increasing regulatory pressure and concerns over consumer debt and fraud associated with crypto purchases. The UK Financial Conduct Authority, FCA, has identified credit-fueled crypto investments as high risk, prompting Barclays to align its policies with regulatory guidance. The bank emphasizes that this decision is aimed at safeguarding customers from the volatile nature of cryptocurrencies, which can lead to rapid debt accumulation if purchased on credit. This policy change by Barclays mirrors similar actions taken by other major UK banks, such as Nationwide, Lloyds, and HSBC, indicating a broader trend of regulatory caution in the financial sector. While the policy restricts the use of personal cards for crypto purchases, Barclays assures that other payment methods, like debit card direct transfers and open banking options, remain available. The FCA anticipates that removing credit channels will reduce susceptibility to scams and impulsive spending, particularly among inexperienced investors. However, the decision has sparked debate, with some industry representatives arguing for customer autonomy and warning of potential shifts towards unregulated exchanges. Despite the pushback, Barclays maintains that the measure is necessary to protect consumer finances and reduce exposure to high-risk investments.
Tether, the prominent stablecoin issuer, has announced an ambitious plan to become the world's leading Bitcoin miner by the end of 2025. CEO Paulo Ardoino revealed this strategy at the Bitcoin conference in Las Vegas, emphasizing the importance of crypto mining in safeguarding Tether's substantial Bitcoin reserves. Valued at over $10 billion, the company is investing heavily in mining and energy infrastructure, particularly across Latin America, with over $2 billion already allocated. These investments are part of a broader strategy to secure Tether's Bitcoin holdings and integrate the company more deeply into the Bitcoin ecosystem. Tether's mining initiative also includes plans to open source its Bitcoin Mining Operating System, MOS, which aims to democratize mining by allowing a wide range of participants to connect to secure networks. This move is intended to enhance the resilience of the Bitcoin network and position Tether as a leader in infrastructure innovation. In addition to mining, Tether is focusing on renewable energy projects in Latin America, such as geothermal initiatives in El Salvador, to ensure sustainable power for its operations. The company's diversified asset strategy, which includes significant holdings in Bitcoin, gold, and U.S. Treasuries, is seen as a hedge against market volatility, with the mining operation expected to generate operational yield and improve asset security.
UAE developers are making significant inroads into the $110.83 trillion U.S. real estate market, following their substantial successes in the UAE, where real estate transactions surpassed $893 billion last year. Key players such as Moafaq Al Ghada, MAG Group, Invest Group Overseas, IGO, Mulk Holding, Dar Global, and Soba Realty have announced new projects across various U.S. cities. This expansion is part of a broader trend of Emirati investments in the United States, which span sectors from real estate to renewable energy. Notably, the UAE has committed $1.4 trillion to U.S. data centers and $60 billion through ADNOC for energy partnerships with major U.S. firms. These developments underscore the strengthening UAE-U.S. economic ties, with the UAE trading with all 50 U.S. states and supporting 161,000 American jobs through bilateral trade. The upcoming America Property Exhibition in Miami, supported by the Dubai Land Department, is set to further enhance this relationship by attracting more U.S. investors to the UAE property market. This event will feature over 100 global real estate projects and aims to foster cross-border investments. As the U.S. housing market approaches a valuation of $50 trillion, driven by a 6.6% rise in value over the past year, the entry of UAE developers could significantly impact market dynamics, offering high yields and diversification opportunities for American investors.
The Reserve Bank of India's RBI latest economic bulletin underscores the resilience of the Indian economy amidst heightened global uncertainties, such as trade policy fluctuations and geopolitical tensions. According to the report, India's GDP growth is projected at 6.5% for the fiscal year 2024-25, with a notable uptick in Q4. The industrial and services sectors show robust activity, supported by high-frequency indicators for May 2025. Notably, India leads in the Purchasing Managers' Index (PMI) expansion among surveyed countries, driven by a surge in new export orders, contrasting the contraction in other major economies. Agricultural performance has been strong, contributing to a benign domestic inflation scenario, with headline inflation remaining below target for the fourth consecutive month. The record crop production in the 2024-25 season has eased food price inflation significantly. While credit growth decelerated in April, non-bank credit sources, including external commercial borrowings, remained robust. Financial conditions are favorable, facilitating effective rate cut transmissions to credit markets. Despite global market volatility, India's equity markets saw modest gains in May to June, recovering from geopolitical-induced fluctuations. The external sector remains stable, with sufficient forex reserves to cover imports and external debt, highlighting the economy's resilience against global economic and geopolitical challenges.
The recent financial developments highlight the significant challenges and opportunities in the global clean energy sector. The primary focus is on the proposed tax and budget legislation by the U.S. House of Representatives, which could drastically reduce support for clean energy technologies by terminating most related credits after 2025. This legislative move threatens to slow down the momentum towards achieving the ambitious targets set at COP28 to triple renewable energy capacity worldwide. The potential reduction in tax incentives may discourage investment in clean energy projects, which require substantial financial resources and innovative financing models to overcome barriers such as outdated power grids in Asia and political risks globally. In Europe, the backlash against the Green Deal and the repeal of corporate greenwashing regulations indicate a challenging environment for clean energy initiatives. The European Commission's decision to remove a rule demanding verifiable evidence of environmental claims suggests a shift in priorities amidst protests and economic pressures. However, the emphasis on accelerating clean energy infrastructure remains, as seen during the EU Sustainable Energy Week. Meanwhile, innovative platforms like EcoYield Energy are emerging as significant players in the regenerative finance space, leveraging blockchain technology to provide decentralized and transparent investment opportunities in clean energy. These developments underscore the necessity for clean energy projects to appeal to economically influential stakeholders by demonstrating strong returns, cost savings, and long-term competitiveness to secure the required capital and political support for scaling up environmental efforts.
The Walt Disney Company has initiated another round of layoffs, this time targeting its product and technology division, which is led by Adam Smith. The layoffs, affecting less than 2% of the team, are part of a broader strategy to rebalance and refocus workforce investments within the division. Despite these cuts, Disney continues to hire and plans to expand its product and tech team, particularly to enhance its streaming services, including Disney+, Hulu, and the upcoming ESPN streaming service. This move is part of Disney's ongoing effort to optimize operations amid a rapidly evolving media landscape. This latest round of layoffs is the fifth in a series over the past year, primarily impacting Disney's TV operations, including marketing, publicity, and financial units. The strategic cuts reflect a trend seen across the media industry, with companies like Warner Bros. Discovery and Paramount also reducing their workforce to adapt to changing market conditions. These layoffs underscore the challenges traditional media companies face as they transition to digital and streaming platforms, necessitating a re-evaluation of resource allocation to remain competitive.
Cameco Corporation, CCJ, is poised for significant growth over the next decade, driven by the increasing momentum in nuclear energy investments. As global energy policies shift towards renewables, nuclear power emerges as a crucial complement due to its zero carbon emissions and reliability. This strategic alignment positions Cameco, a leading uranium producer and nuclear service provider, to capitalize on the growing demand for stable energy sources that can offset the intermittency of renewables like wind and solar. The U.S. Department of Energy's data highlights nuclear power's exceptional capacity factor of 92.3%, underscoring its reliability compared to other energy sources. Despite constituting only 8% of the U.S. energy capacity, nuclear power generated 18% of the country's electricity in 2023. This reliability is critical as it supports energy security and complements renewable investments. Cameco's strategic investments, including a substantial stake in Westinghouse, further solidify its position as a key player in the nuclear sector, making it an attractive long-term investment for those betting on the future of clean energy.